Okay, let's just jump right into this. Today isn't just another Thursday, and we're not just covering another earnings report. We're doing something a little different.
We're sort of looking into a crystal ball.
Exactly. We are, for all intents and purposes, time traveling. We're placing ourselves in the middle of a storm that, based on this stack of forensic analysis you sent over, is set to hit on February 5th, 2026.
It's a date I think is going to be circled on a lot of calendars for a long time. I honestly believe people will remember where they were when this news broke.
I think so too.
Yeah.
So let's set the scene for everyone listening. Picture this. It's the morning of February 5th, 2026. You grab your coffee, you pull up your news feed, and Microsoft, the titan, the absolute bedrock of tech, the stock your grandmother owns, has just dropped its earnings.
The safest of safe bets,
At
right?
the safest bet. And if you just glance at the headlines, if you just read the big, bold print, it looks like, well, the greatest quarter in the history of business.
On the surface, it looks like they've done it. Like they've completely cracked the code on the entire economy. A total victory lap.
A victory lap. It looks like a ticker tape parade. I mean, seriously, look at these numbers with me. They reported a 60% jump in profits.
60.
60%. For a company this size, worth trillions of dollars, to grow its profit by 60% in a year. That's just unheard of. It doesn't happen. They beat every single Wall Street expectation.
Every single one.
And yet,
This is the paradox, isn't it? This is why we're doing this deep dive. Because while I'm sitting here, wanting to pop the champagne and celebrate the AI revolution finally paying off, the market, well,
the market did the exact opposite.
it did something completely different.
They didn't pop champagne. They pulled the fire alarm.
They did. Despite what looks like a perfect report, despite blowing past every estimate, Microsoft's stock just collapsed. It wasn't a little dip either. It fell 12% overnight.
Which, for a company this size, is a number that's hard to even wrap your head around. We are talking about $350 billion in market value. Just poof, evaporated, gone in a single night.
To put that figure in perspective for everyone, that's like the entire value of a company like, say, Netflix or Coca-Cola just vanishing while everyone slept. It's a truly staggering figure.
It's a bloodbath, an absolute bloodbath, and that is the central mystery we are here to solve today. Why? Why on earth did the smart money, the big funds, the institutional investors, the people who supposedly know what they're doing, why did they run for the exits?
Because they didn't just read the headline, they didn't stop at the press release, they went straight to the fine print, straight to the footnotes. And what they found there wasn't a success story.
No.
It was a trap.
A trap. That's a strong word.
It's a $2 trillion trap. We are going to unpack what our sources are calling the OpenAI curse.
The OpenAI curse. Okay, that sounds suitably ominous. What does that mean?
It is. Look, there are three specific things in this report that absolutely terrify the market. First, the accounting magic that basically manufactured that profit beat.
Second, something called a circular debt trap that's worth $625 billion. And finally, and this is the big one, this is the real focus, a depreciation time bomb that is set to go off right around 2028.
A time bomb. All right, I'm listening. But look, before we get all forensic and frankly gloomy, I have to play devil's advocate for a second.
Please do.
Because I look at this report and I see a company that is just winning. I see the believer's case. I want to represent the person listening who's thinking, hang on, Microsoft is the king of AI. They're dominant. Why are we even thinking about betting against them?
And that's a perfectly fair position. So walk me through it. Be the bull. What did you see on the morning of February 5th that made you want to buy, not sell?
Dominance.
Yeah.
Pure and simple. We already talked about the 60% profit increase, but let's look at the cloud numbers for a second. Azure growth is sitting at 39%.
39, which is an incredible number. It's miraculous. In what's supposed to be a mature market, to grow your cloud business by nearly 40%. To me, that says the demand for AI is not just real, it's here. And Microsoft is the one capturing all of it.
It certainly paints a picture of, explosive, unstoppable demand. 39% is a number that startups dream of, not a multi-trillion-dollar incumbent.
Exactly. And then you hear people complaining about the spending, they see the capital expenditure line item, the CapEx, and they totally freak out. But I look at that and I see them investing in the future.
You see it as a good thing.
I see them building the factories of the 21st century. I see them digging the moat.
The moat. That word comes up a lot in the bull case, doesn't it?
It has to. Because with OpenAI, they have built an unassailable fortress. Every company is going to need AI compute, and Microsoft is positioning itself to be the utility provider for the entire future economy.
So like owning the power grid.
It's exactly like owning the electric grid in 1900. Who cares if you spend a ton of money building out the grid if you get to sell electricity to everyone forever? That's the bull case.
And look, it's a very compelling narrative. It's the story that has driven this stock to incredible heights for years. It's that classic tech story. Spend whatever it takes now and reap the rewards for a century.
Right.
But this is where we have to put on our forensic auditor hats.
Mm-hmm.
Because if you start to peel back the layers of that 60% profit figure, that moat, it starts to look a lot more like a sinkhole.
Okay, unpack that for me. You're saying the profit isn't real profit. How can that be?
I'm saying it's not what you think it is. Let's look really closely at that 60% jump. Buried inside that profit number is a very specific, very interesting line item, a $7.6 billion gain.
7.6 billion. That's a huge chunk of change. Okay, so where did it come from? Did they sell a record number of Copilot licenses? Did they sign some massive government deal?
No, none of the above. That money didn't come from selling software. It didn't come from new Azure subscriptions. It didn't come from any of their operations at all.
Then where did it come from?
It was a paper gain. It was derived from revaluing their investment stake in OpenAI.
Wait, hold on. So they just decided that their piece of OpenAI was worth more money, and then they booked that decision as profit for the quarter.
In essence, yes. It's accounting magic. It is a non-cash gain. Look, imagine you own a rare baseball card. You bought it for $100. A year later, you look at auction prices and you decide, based on what other people are saying, that your card is now worth $1,000.
Okay.
You haven't sold the card. You don't have an extra $900 in your pocket. But on your personal spreadsheet, you write down, look, I made $900 in profit this year. That's what this is.
I see. So it's a ghost profit. It exists on paper, but you can't use it to pay salaries. You can't use it to buy more servers.
Exactly. And here's the massive risk. That profit is entirely dependent on the valuation of OpenAI continuing to go up and up and up. If that AI bubble pops, or even if it just deflates a little bit, that $7.6 billion profit instantly transforms into a massive write-down.
It becomes a loss just as fast as it became a gain.
Faster. And so Wall Street, or at least the smart money on Wall Street, saw this number and they immediately realized, hey, wait a minute, this isn't real organic growth. This is just a valuation pump.
They saw through the facade. They figured out that a huge chunk of this record-breaking quarter was just, fluff.
Precisely. But believe it or not, that's actually the small problem.
Wait a second. A $7 billion fake profit is the small problem. What could possibly be bigger than that?
Compared to what else is lurking in these footnotes, yes. The much bigger problem is the circular nature of the revenue they are booking, the real revenue.
Okay, let's go there. Because even if we take out that paper gain, they still posted massive revenue numbers. I'm looking right here at the RPO, remaining performance obligations. It's at $625 billion.
Well, a monster number.
That is $625 billion of future revenue that is already under contract. How can you possibly spin that as a bad thing? That proves the demand is there. It proves customers are lining up around the block.
It proves that contracts exist, yes. But yeah, I have to ask the most important question. Who is signing those contracts? And this brings us to what the analysts are calling the circular debt trap.
Circular debt trap. That sounds like a financial horror movie, or maybe a really, really bad carnival ride.
It's a bit of both, honestly. Let's break down that $625 billion figure. A huge, huge chunk of it, our sources say nearly $281 billion of it, is a commitment from one specific partner.
And let me guess who that partner is? OpenAI.
OpenAI, of course. Now, just think for a second about the relationship between Microsoft and OpenAI.
Mm-hmm.
How does OpenAI pay its bills? Where does it get its money?
Well, from Microsoft. Microsoft invested tens of billions into them. That was the huge news a couple years back.
Right, so follow the money. Step one, Microsoft gives OpenAI billions of dollars in cash and, even more importantly, in cloud credits. So Microsoft hands a bucket of money to OpenAI.
Okay.
Step two, OpenAI then commits to spending that exact same money back on Microsoft's Azure servers over the next few years.
I think I see where you're going with this now.
It's a completely closed loop. Microsoft then takes that commitment from OpenAI and records it on its own books as future revenue, or RPO. But where did the money to make that commitment come from in the first place?
It came from Microsoft.
It came from Microsoft. It's genius in a terrifying way.
So it's Okay, let's use that analogy from the notes because it makes it so clear. The lemonade stand analogy.
It's the perfect way to visualize it. It's exactly that. Imagine I set up a lemonade stand. I reach into my left pocket and I pull out $10. I hand it to you.
Right.
You then immediately turn around and use that $10 to buy a cup of lemonade from my stand. I take the $10 from you, put it in my right pocket, and I start screaming to the whole neighborhood, "Look! I just made $10 in revenue. My lemonade business is booming."
But you didn't actually generate any new wealth. You didn't find a new customer. You just moved your own $10 from one pocket to the other.
And you paid for the lemons and the sugar and the cups in the process. You actually lost money on the transaction. That's the left pocket, right pocket shuffle. And so these forensic analysts are looking at that incredible 39% Azure growth number, and they're asking, how much of that is real organic growth from third-party companies buying cloud services? And how much is just Microsoft's own investment money coming back home disguised as revenue?
And that's a deeply concerning question because if you were to strip that circular revenue out, the growth rate would probably look a lot more pedestrian. It would look like a normal company, not a rocket ship.
It would be much, much lower. And you have to remember, the stock price isn't priced for normal. It's priced for hypergrowth. It's priced for perfection. If the real organic growth is actually 15 or 20% instead of nearly 40, then the valuation of the company makes absolutely no sense.
I tried to defend this in my head as just, ecosystem building. You seed the market, you help your key partners get off the ground. It's standard venture capital stuff, right? But you're calling it a closed loop.
Because it seems to be a closed loop, designed primarily to pump the stock valuation, not to generate real, organic, sustainable cash flow. And it's a great strategy. It works for a while, until the investment money runs out. Or, more likely, until investors realize that the return on investment, the ROI from all this, it just isn't there.
Which brings us, I guess, to the spending side of the equation, because to keep this whole loop going and to keep building out this supposed moat, they are spending an absolute fortune.
A fortune doesn't even begin to do it justice. We really need to talk about the sheer scale of this spending. We need to talk about the Apollo Moon mission.
I loved this comparison in the research notes. It's one of those things that really puts these abstract numbers into perspective because after a while, billions, trillions, they just start to sound like fake monopoly money. So break it down for us. Make it real.
Okay. In the single quarter we are discussing, just 3 months of operations, Microsoft spent $37.5 billion on CapEx, capital expenditure. That's spending on physical things like hardware, data centers, and most importantly, chips.
$37.5 billion in one quarter. It's a huge number, but again, I need context. How does that compare to history? Is that normal for a tech giant in a growth phase?
Let's use the Apollo Moon mission as our measuring stick. The entire program. From President Kennedy's speech all the way to Neil Armstrong's first steps and the final splashdown. The whole decade-long effort.
The whole thing.
If you take the total cost of that entire program and you adjust it for inflation to today's money, it costs roughly $150 billion.
$150 billion for the entire moon landing program. Developing the rockets, the suits, the computers, everything.
Everything. Microsoft is now spending an Apollo Moon mission budget every 4 quarters.
You're kidding.
Their annual spend on CapEx is now approximately $150 billion a year.
That's insane. They are literally burning through a moon landing's worth of cash every single year.
And here is the absolutely crucial difference. When NASA spent that money, they were doing something that had never been done. They were building, in some cases, permanent infrastructure. They built launch pads that lasted for decades. They were developing new materials science that changed the world. But what is Microsoft buying with its $150 billion?
Well, they're buying chips.
Right.
They're buying DPUs, NVIDIA H100s, B100s, whatever the latest and greatest is. They're just racking servers in data centers.
Exactly. They are not buying land.
Yeah.
They are not buying steel or other permanent assets that will hold value for 50 years. They are buying silicon. And this is what leads us to the most dangerous part of this entire deep dive.
Yeah.
The absolute core of the bear case. The depreciation time bomb.
Right. This is the part that sounds a little technical, but I have a feeling it's where the real pain is hiding. So explain depreciation time bomb to me like I'm 5. Or maybe explain it to me like I'm a slightly panicked investor holding the stock.
It's going to hurt a lot.
Yeah.
So we have to look at the nature of the assets they're buying. In their own conference calls, management admits that 2/3 of this $150 billion annual spend goes to what they call short-life assets.
Sure life assets, which is just corporate jargon for things that break or go obsolete really, really fast.
Correct. We're talking about these GPU chips. These things cost $30,000, $40,000 a pop, and they are run hot 24/7. And the technology in the space is moving at lightning speed. So these chips have a functional, useful life of being generous, maybe 3 to 5 years.
So unlike a factory building that stands for 30 years or a railroad track that lasts for a century, these multi-billion-dollar chip orders are destined for the trash heap pretty quickly.
The term used in one of the Korean source analyses was jeonjasuregi.
Jeonjasuregi, what does that mean?
It's Korean. It means electronic waste. By 2029, all of this state-of-the-art hardware they are buying today, this $150 billion worth of equipment, is going to be electronic waste. It will be obsolete. It will be scrap metal and silicon.
Okay, so let's play that out financially. Why is that a time bomb? Why didn't it hurt them in this report? If they spent the money, why isn't the profit number lower right now?
Because of the magic of accounting. When a company buys a big capital asset like a server, they don't list the full cost as an expense on their income statement right away.
Okay.
It goes onto the balance sheet first. It sits there as an asset, like a house you just bought. It doesn't touch your profit and loss line yet.
Got it. So they've spent the cash, the money is gone, but it doesn't look like a loss on their earnings report yet. It's sort of hiding.
It's hiding, but, and this is the key, every year you have to depreciate it. You have to officially acknowledge that the asset is losing value over time. If the asset, say, has a useful life of 3 years, you have to take 1/3 of its original cost and move it from the balance sheet to the income statement as an expense every single year for 3 years.
Oh boy. I can see the train coming down the tracks now.
Right now, in early 2026, they are in the buying phase, so the costs are still hiding on the balance sheet. But starting in late 2026 and really ramping up into 2027 and 2028, that depreciation bill starts to come due.
And it's not just one bill. It's a bill for the stuff they bought this year, plus a bill for the stuff they buy next year.
It stacks up. And the total bill is for $150 billion of spending per year. Imagine when $50 billion, then $60, then $100 billion of raw depreciation expense starts hitting the profit line every single year. It will create what one analyst called a margin massacre. The net margins of the company will be incinerated.
So the incredible profit we saw in this report, that 60% jump, that's only possible because the bill for all the spending hasn't actually arrived yet.
It's like charging a luxury vacation to a brand new credit card with a 0% introductory APR for 12 months. You feel rich, you're living it up in the 5-star hotel. But in month 13, reality hits you like a freight train.
And the critical question, the one that these forensic analysts are screaming from the rooftops, is this. How does Microsoft ever pay back a $150 billion annual spend when the assets they're buying go completely obsolete in 36 months?
The returns would have to be astronomical. You'd need AI to be generating trillions of dollars in actual profitable economic value, like right now. You'd need every single one of those chips to be printing money faster than they burn out.
And is that happening? This brings us to the expensive intern concept from the notes, right?
It's expensive intern. It's a fantastic way to think about this ROI problem. Yeah. So some of the best analysis on unit economics suggests that a single complex ChatGPT query costs about 4 cents to run. That's the electricity, the computing power, the water for cooling, everything.
4 cents per question.
But then you have to ask, how much economic value does that query actually generate? For the average user asking for a poem about their cat or a recipe for lasagna, it probably generates, maybe 1 cent in value, maybe less.
So for a huge portion of their traffic, they are actively losing money on every single transaction.
In many cases, yes. The fundamental business model right now for the vast majority of AI use cases is insolvent. It costs more to deliver the service than the service is actually worth to the user.
But the bull case, the argument from my side, would be that they are banking on the tech getting better, cheaper, and faster over time. They are banking on that moat keeping them ahead until the unit economics finally work out. That's the standard Silicon Valley playbook, isn't it? Lose money on every user until you have all the users, then figure out how to make money later.
And that strategy brings us right back to the question of the moat. You mentioned earlier that Microsoft has built this unassailable lead because of its partnership with OpenAI.
I did. That's the common wisdom on the street.
Well, let's put that common wisdom to the test. Have you looked at the LMSYS Arena leaderboard recently?
The chatbot arena. Yeah, that's the one where they have real humans blind test different AI models against each other side by side to see which one is actually better.
Exactly. It's pretty much the only real, unbiased, head-to-head benchmark that we have in the entire industry.
Yeah.
And what does that data show?
I have a feeling you're about to tell me that OpenAI isn't crushing everyone anymore.
They aren't just not crushing everyone. They're losing. Models from Google and from Anthropic are now consistently beating GPT-4 in performance benchmarks. The technological lead, it's gone. It's evaporated.
Well, that's a huge problem. If you're spending $150 billion a year to build a giant moat around your castle, but the castle itself is already being overrun by invaders.
Precisely. Microsoft has tied its entire future and its entire balance sheet to this one single partnership. But if OpenAI is losing its technological dominance, then Microsoft is effectively tied to a sinking ship. But they are still footing the bill. They are still paying to keep that circular revenue loop going.
So they're paying a premium, market-leading price for a product that is rapidly becoming a commodity.
A rapidly depreciating commodity powered by rapidly depreciating assets. You see the pattern.
This all feels very familiar. I feel like I've seen this movie before. The massive infrastructure spend, the wild valuations, the collective belief that this time it's different. It just screams .com bubble.
It absolutely does. And everyone, a lot of bulls especially, loves to make the comparison to Cisco back in 2000.
Right, that's the classic argument. Cisco was the infrastructure winner. They made the routers and the switches, the picks and shovels of the internet age. And even though the internet turned out to be real and transformative, Cisco's stock still crashed and took 20 years just to get back to even.
That is the history. It's a cautionary tale. But here is the terrifying twist. In this scenario, in 2026, Microsoft is not Cisco.
Wait, really? I thought the whole argument was that since they are building the infrastructure, they are the new Cisco?
No. Let's do a quick logic audit here.
Yeah.
Let's go back to the year 2000. Cisco sold the pipes, right? They sold the hardware. Who were their main customers?
The .coms. Pets.com, Webvan, all those companies that had crazy ideas but no actual profit.
Exactly. The .coms were the customers. They were the ones burning through mountains of venture capital or cash to buy Cisco routers to build businesses that ultimately didn't work. The .coms were the bubble.
Okay, I'm following you.
Now, let's look at today. Who is selling the picks and shovels? Who is selling the chips?
NVIDIA?
NVIDIA, Cisco. NVIDIA is the one selling the essential hardware with absolutely massive profit margins.
So then who? Who is the .com customer in this analogy?
Microsoft is.
Ouch.
Microsoft is the .com customer. They're the ones over-ordering chips to fuel a bubble. They're the ones burning through their own balance sheet to buy infrastructure for a business model, the expensive Intern, that has not yet proven its ROI.
That completely flips the script. We're so used to thinking of Microsoft as the adult in the room, the stable, profitable giant. But you're saying they are behaving like a desperate startup burning through VC money, except the venture capital is their own hard-earned cash.
And that is why the smart money sold on February 5th. They did this exact logic audit, and they realized that Microsoft has positioned itself to be the bag holder for the entire AI industry.
So when does it all break? I mean, really, truly break. We had this 12% crash, but the company is still massive. It's not going bankrupt tomorrow.
No, absolutely not bankrupt. But the real stock price correction, the one that hurts. My prediction, based on these models, is that the crack truly begins in late 2026.
Why then specifically? What happens in late 2026?
Because that's when the chief financial officers finally take over from the chief executive officers. Right now, the CEOs are in charge of AI strategy, and they are all terrified of FOMO, the fear of missing out. They were running around telling their teams, spend whatever it takes. We need an AI strategy yesterday.
Just get me the GPUs. I don't care what they cost.
Exactly. But eventually, a year or so from now, the CFO in every company is going to look at the spreadsheet. They're going to see the depreciation from the GPUs hitting the income statement. They're going to look at the actual measurable revenue coming back from their expensive intern AI projects. And they're going to realize the math just doesn't work.
And they turn off the tap.
They turn off the tap. They cancel the purchase orders for more chips. The circular revenue loop at Microsoft breaks. The Azure growth rate collapses. And at the exact same moment, the depreciation expenses from all the previous year's spending hits the income statement like a tsunami. That is the crack.
It's a very sobering thought. We started this deep dive looking at what seemed like a record profit report, and we've ended up predicting a margin massacre and a crack in the market.
It's just so important to look past the hype. The numbers don't lie, but you have to know which numbers to look at. You have to ignore the bold print and go searching in the fine print.
So let's try to wrap this all up for the listener. We've covered a ton of ground here. If you had to summarize the entire forensic case against Microsoft, what's the elevator pitch? If I'm trying to explain this to my friend at a bar tonight, what do I say?
The elevator pitch is simple. Don't fall for the headline profit number. The $2 trillion danger for this company is real. And it's a combination of three distinct things. First, accounting magic that's hiding a lack of real organic growth. Second, a circular debt trap with their biggest partner that's artificially inflating their revenue. And third, a depreciation time bomb that is set to absolutely destroy their profit margins over the next 24 months.
And the final thought, where does all of this leave us? What should we be thinking about?
It leaves us with the concept of the 2028 extinction event. There will be survivors of this. AI is real technology. The internet was real too, and Amazon famously survived the dot-com crash and thrived. But 90% of the other companies didn't make it.
So who survives this time around?
In the long run, the companies that own the electricity and the ones that own the raw proprietary data, not the ones who are just renting the processors in the middle. But for the investor, for you, the listener, the advice is simple. Don't be the one caught holding the bag in the middle of the circular loop.
So wait for the dust to settle before jumping in.
You wait for what analysts call the 90% haircut. When this bubble finally bursts, there will be an incredible sale. There will be amazing companies to buy. But we are not there yet.
A 90% haircut. That is a truly terrifying image for anyone holding the stock today. But it's a vital perspective to consider.
It's the only way to protect yourself from what's coming.
So here is the final question we want to leave you to think about today. We've laid out both sides of the case. Is this crash on February 5th, 2026, the first tremor? Is this the beginning of the 2026 AI crack? Or is it just a fantastic buying opportunity for the true believers?
That's the multi-trillion-dollar question, isn't it?
Thank you for joining us on this deep dive into the OpenAI curse. It's been fascinating. It's been a little bit scary, but hopefully you're walking away with a much clearer picture of what's really going on behind those glossy earnings reports.
Always remember to read the footnotes.
We'll see you on the next deep dive.